Hello and welcome back. It is Monday, January 19th, 2026. Hope your win is off to a good start. We have a really fascinating deep dive planned for today. It's for anyone who's ever watched the market and just gotten that feeling that, well, that the rules have changed.
They really have. Today isn't about earnings reports or, the headlines you see on TV. We're going under the hood. We're looking at the actual plumbing of the U.S. markets.
Which feels so necessary. Because I think we've all had that feeling, right? You're watching a stock and the price just feels stuck, like it's a magnet at a certain number.
Or the opposite.
Or the opposite. The whole market just takes a nosedive at 3 p.m. for no reason at all.
Right. And that's not your imagination. It's not bad luck. It is the machinery of the market, specifically the derivatives market, completely overpowering everything else.
So to help us figure this out, we're diving into a brand new document. It's called the Strategic Derivatives Report, OPEX Dynamics, Volatility Structure, and Market Microstructure. And it's dated today. And the mission here seems to be about shifting how we think, moving away from just buy and sell.
Exactly. The core idea here is that stocks don't just move because Apple sold a lot of iPhones anymore. We're in an age where options, these derivatives, have gone from being insurance policies to being the tail that wags the dog. If you don't get the side bets, you just can't understand the main game.
Okay, let's get right into it then, because the report talks about a new hierarchy of how money moves. It starts with OPEX, option expiration. Now, when I first started, OPEX was like a monthly thing. It was predictable.
The third Friday of the month, that was the day. And, for the really big money, the structural institutional money, it still is.
So pension funds, that sort of thing.
Exactly. If you're hedging a multi-billion-dollar portfolio, you're on that monthly cycle. That's where the huge walls of money are.
So that's the base layer. But then in 2005, we got weeklies.
Right. Weeklies came in to sort of smooth out the risk. Instead of one giant cliff edge every month, you could spread things out a bit. It made things more tactical. But honestly, that was just the appetizer.
The main course, and this is the part of the report that really it blew my mind, is the zero DTE revolution. 0 days
To
expiration.
This is the game changer. These are options that are born and die on the exact same day, Monday through Friday, every single day.
And the report has this statistic that just feels wrong. It says 0 DPE volume is often over 50% of the entire daily volume for the S&P 500.
Stop and think about that. Really think about what that means.
Yeah.
More than half the trading in the world's most important index isn't investing.
Mm-hmm.
It's not even swing trading. It's wagering on what happens in the next few hours or even minutes.
The report calls it a bifurcated market.
That's the perfect term. You've got the structural market down here, people buying a company for its cash flow.
Yeah.
And then layered on top, you have this super fast casino that's just surfing these intraday waves of liquidity.
And the danger is when that top layer gets too heavy, right?
It forces the real market to move in ways that make absolutely no fundamental sense.
Okay, so this brings us to a really practical gotcha moment in the report. The difference between trading the ETF, like SPY, which everybody knows, and the index itself, SPX.
Yes.
To most people, it seems like the same trade. You're just betting on the S&P.
And that assumption is exactly where retail traders get blown up. I mean it. If you only take one thing away today, let it be the difference between physical and cash settlement.
Okay, break down. Why is physical settlement, which is what SPY uses, such a trap?
All right, picture this. You've got a call option on SPY. It expires Friday. The market closes just one single penny above your strike price. You are in the money.
So you won.
You would think so. But it's physically settled. You don't get cash. The system says, great, you get to buy the stock. So on Monday morning, you are forced to buy 100 shares of SPY for every single contract you hold.
And SPY is trading at, what, $500, $600 a share?
So if you have 10 contracts, that's 1,000 shares, suddenly you have a $500,000 position in your account that you did not ask for.
And if I don't have $500,000 just sitting there?
Then you wake up to a margin call. And your broker immediately sells your position, probably at a terrible price. But there's a worse version of this. It's called pin risk.
The report calls this a nightmare scenario.
It is. Imagine you sold a spread. You're betting the price stays below a level. The stock closes exactly on your price, a tie. But the other guy, the person who bought the option, has until 5:30 p.m. to decide if they want to exercise it.
Wait. The market closes at 4, but they get an extra 90 minutes.
An hour and a half of overtime. So let's say some news breaks at 4:30. The market gaps up after hours. The other person sees that, exercises their option, and boom, you wake up Monday with a massive position already deep in the red.
That is terrifying.
It can wipe out months of work in a single morning.
So how do we avoid this?
Trade the index, SPX. It's cash settled. There are no shares. You win, cash appears. You lose, cash leaves. The end. No overnight surprises.
Plus, the report mentions a tax benefit, too, for U.S. traders.
A huge one. Section 1256. With SPY options, it's all short-term gains, so you're taxed at your highest rate. With SPX, even if you hold it for 5 minutes, 60% of your gain is taxed at the lower long-term rate. It's a massive difference.
So, cleaner, safer, more tax efficient.
Yeah.
But just when you think you're safe, the report mentions this AM versus PM settlement. Another trap.
The morning trap. Most options now are PM settled. They expire at 4 p.m., the bell rings, price is set, you're done.
Simple.
But the big monthly options, those old school ones on the third Friday, are often AM settled. They stop trading on Thursday afternoon. But the final price isn't set until Friday morning.
So you're locked into a position from Thursday close to Friday open. You can't get out.
Exactly. And the final price is based on the opening prints of all 500 individual stocks. So a few big names have a weird open, the settlement price can gap way away from where you thought you were. You can go to bed a winner and wake up a loser.
Okay, that's a crucial warning. I want to pivot to the why of the price movement. We talked about stocks feeling stuck. The report says this is the invisible hand of gamma.
Ah, gamma.
Yeah, this is where a lot of people's eyes glaze over. Can you put this in plain English for us?
Let's try. To get gamma, you have to get the dealers, the market makers. Their job is not to bet on the market. Their job is to be neutral.
They're just the middleman.
Right. But when they sell you a call option, they're suddenly short the market. If the market goes up, they lose money. So to stay neutral, they have to hedge. They have to buy stock. Gamma is just the math that tells them how much to buy as the price moves.
The report talks about long gamma versus short gamma. What's the difference for us watching at home?
This is the key. When dealers are long gamma, they act like stabilizers. If the market drops, their math forces them to buy. If the market rallies, they have to sell.
So they're fighting the trend.
They're fighting the trend. They're pushing the price back to the middle. It's like having huge shock absorbers on your car. It just kills volatility.
Which explains those days where the market does absolutely nothing for hours.
Yeah.
So short gamma is the opposite.
It's the opposite, and it's dangerous. In a short gamma world, if the market falls, the dealers are forced to sell more.
Which pushes the price down even further.
And that forces them to sell even more. It's a feedback loop. Short gamma is pouring gasoline on the fire. That's when you see crashes accelerate. The shock absorbers are gone.
And this leads right into pinning, doesn't it? The magnet effect.
Exactly. It's not a conspiracy. If there's a huge amount of options at, say, the $150 strike on Apple, and dealers are long gamma, their own hedging creates a gravity well. The further the price moves from 150, the stronger their hedging pushes it back.
It's just thousands of algorithms solving for zero.
That's all it is. And that's really what max pain is. It's not some evil plan to hurt retail. It's just the point where the gamma is stickiest.
So let's talk about the big one, triple witching.
Sounds spooky, right?
It does. It happens 4 times a year.
Yeah.
Futures, index options, stock options, all expiring on the same day.
And the common myth is that the market is going to go haywire or crash.
You see it on Twitter every quarter. Get ready for triple witching.
And they're almost always wrong. The report makes it clear. Triple witching is about volume, not necessarily volatility. It's just institutions rolling over their positions. They're closing a March contract and opening a June one.
Just extending their position.
They're not making a new bet. They're just extending the lease.
But the report does flag the last hour, 3 to 4 p.m., as the witching hour.
That's where the action is. Big funds use market on close orders, MOC orders. They have to transact at the exact closing price.
And 3:50 p.m. is the magic time. Why then?
That's when the NYSE publishes the final order imbalance. It basically announces to the world, hey, we have $5 billion of stock to buy at the close.
The cards are on the table.
The cards are on the table, and for the last 10 minutes, the high-frequency algos see that imbalance and they try to get in front of it. That's when you can get a huge flush or a rip right into the bell.
So not the time to go grab a coffee if you're a day trader.
Definitely not.
Speaking of taking a break, let's just pause here for a moment. If you're enjoying this deep dive, we'd love it if you'd subscribe to the channel, leave a like, and maybe drop a comment on what you want us to tackle next.
And if you check the description, you'll find a PayPal link if you feel like supporting the project.
Your contribution really does help us keep making content like this. We're not asking for more than the price of a coffee, so thanks for the support.
All right, let's get back to it. We have to talk about the VIX.
The fear gauge. Everyone watches it, but the report says almost nobody understands it.
The VIX complex is a totally different animal.
Yeah, the biggest misconception seems to be people treating it like a stock. They think, oh, I'm scared, I'll just buy VIX.
You can't buy VIX. It's a math statistic. It's an idea. You have to trade futures or options on that idea. And the first little quirk is that VIX options expire on a Wednesday morning, not Friday.
That gets people all the time. But the bigger issue is the structure. The report talks about contango and backwardation.
Sounds painful. And for a lot of people, it is. A normal market is in contango. It just means future volatility is expected to be higher than today's.
Makes sense. More time means more uncertainty.
Right. So the VIX futures for 3 months from now are more expensive than the ones for today. Now, if you buy an ETF like VXX, it has to constantly sell the cheaper expiring future and buy the more expensive one.
It's forced to sell low and buy high.
Every single month. It's called negative roll yield. It means those products are mathematically designed to bleed value over time. It's like trying to hold an ice cube in the sun.
So buying and holding a VIX ETF is a losing game.
Unless you get the timing perfect on a crash, yes. It's a short-term tool, not an investment. The only time that flips is during a panic, which is backwardation.
That's the signal.
That's the signal. When today's fear is higher than future fear, that's the only time that roll yield works in your favor.
The report also brings up the skew index. It calls it the silent panic detector, which I love.
Skew is a fantastic tool. VIX measures the options right near the current price. Skew looks way, way out of the money. It's measuring the demand for disaster insurance.
How much are people willing to pay for lottery tickets that only pay out if the world ends?
Exactly. So if the VIX is low and everything looks calm, but skew is really high, it means the big money, the whales, are quietly buying protection while everyone else is relaxed. It's a huge warning sign.
Silent panic. I'm adding that to my charts. Okay, we've covered a ton of theory. Let's make it practical. The report has a trader's survival checklist. What do we actually do with this on a Tuesday morning?
First, you have to watch the clock differently. The flows create patterns.
It flags the first half hour, 9:30 to 10 a.m. as the fake-out zone.
Right. That's just dealers adjusting their hummus from overnight. You can't trust that initial move. It's just mechanical noise.
And then there's the power hour, 3 to 4 p.m.
That's when the zero TE flows really take over. If you see a strong trend start after 3 p.m. on an expiration day, you have to respect it. It's probably being driven by massive dealer hedging.
Okay, let's run through the golden rules from the report.
Rule number 1. The pin risk rule. If you are in a spread on a stock or on SPY and the price is anywhere near your strikes on expiration day, just close it. Get out before 3:45 p.m.
Don't gamble on the close. It's not worth it.
Never. Rule number 2, the AM rule. Do not hold monthly SPX options overnight from Thursday to Friday. You're just gambling on the opening print. It's pure luck.
And the third one mentioned Vanna and Charm flows. We didn't get deep into those, but what's the quick takeaway?
The simple version is, if it's OPEX week and you see the market slowly drifting up while the VIX is falling, that's a mechanical flow. Dealers are being forced to buy back their hedges. Don't fight it.
Don't fight the flow. That feels like the theme for this whole thing.
It is. The market used to be about finding value. Is this stock cheap? Now you have to look for the flow. Where's the liquidity? Where's the gamma?
So as we wrap this up, that really is the big question, isn't it?
I think so. The main takeaway is that the plumbing matters more than ever. You can be 100% right about a company's fundamentals, but if you step in front of a giant dealer hedging flow at 3.55 on a Friday, you are going to get run over.
You have to respect the machine just as much as you respect the balance sheet.
You do. And it leaves us with this final thought to chew on. In a market so dominated by daily options and automated hedging, does fundamental value even matter intraday anymore? Or are we all just surfing these waves of liquidity?
Something to think about. And with that, we have reached the end of today's deep dive. We hope you liked it, learned something new, and that you'll join us for the next one.
Thank you very much, and we will meet again very soon.
Remember that in the description, you can find that PayPal link if you want to help us out. Thanks once again. Greetings.